Warahmatullahi wabarakatuh. My name is Adrena Batrisha binti Karubarin and I will be explaining about what is share repurchase. What is a share repurchase? A share repurchase, or also known as share buyback, is a transaction in which a company buys back its own shares from the market. Why would a company buy back its own shares? A company might repurchase its shares for many different reasons, such as the management considers the shares are undervalued, to boost the value of stock, or to improve the financial statement. Furthermore, a company may purchase shares directly from the market or offers its shareholders to tender their shares to the company at a fixed price. This action will reduce the number of outstanding shares and the earning per share will increase. Besides, the investors often consider that buybacks will cause the price to increase. This assumes that the action will not reduce the demand for shares.
Assalamualaikum. My name is Nurul Fatiha binti Kamaruzaman and I will continue on the advantage of stock repurchase. First and foremost is avoiding poor investment decision. Making the right investment decision to grow a business can be difficult and it requires capital which can be raised through equity or debt. For investors and lenders to provide funds, they expect a certain return, and if a company fails to generate a high enough return on its investment, it is essentially reducing shareholder value. In that situation, buying back stock as a method of returning profits can be a proper way of making meaningful use of excess cash. A large cash balance can have a value-destroying effect on a company when it uses the cash to make unprofitable investment decisions in compared to the cost of raising capital. Companies with a history of poor investment decisions should not use any excess cash balance to fund further investment. Investors would expect the company to distribute that cash to shareholders instead. In that case, share repurchase would be a beneficial use to all owners within the business. Next is reduce equity financial costs. The most reasonable interpretation of a stock repurchase is that the company is doing well enough that it no longer needs as much equity capital to fund its expansion plans. Instead of carrying the burden of unnecessary equity and the dividend payments it requires, a company's management team may simply choose to buy existing shareholders out of their stakes. As a result, the business average cost of capital is reduced. That said, it's important to remember that one of the key objectives of equity capital is to fund growth. So, when a company offers to buy back stock from shareholders, this could indicate that the business long-term growth prospects are not as attractive as they once were. Because expansion opportunities are limited, companies with a strong presence in their respective industry frequently repurchase shares.
Assalamualaikum, my name is Nurul Ezah Pitigani and I will be continue with the advantages of share repurchase. So, the third advantages of share repurchase is it can capitalize on undervalued shares. A good incentive for a company's management to conduct a share repurchase would be when those shares are trading at an undervalued price. It can be used as a strategic device aimed at generating even more proceeds without having to issue additional shares. When a company repurchases shares that are undervalued, all shareholders who are willing to sell their shares will seize their undervalued shares to the business, while all the remaining shareholders should be able to get benefit from those share repurchases in the future. If management feels its stock is undervalued, it can choose to repurchase some or all of the outstanding shares at the deflated price and wait for the market to correct. When the stock price moves back up, the company can then reissue the same number of shares at the new higher price. The result, total equity capital increase while the number of outstanding shares remains stable. The fourth advantages of share repurchase is showing positive signals to investors. A share repurchase shows the corporation believes its shares are undervalued and is an efficient method of putting money back in investors' pocket. Shortly after a business announced to repurchase shares, the stock price of that company often increased as a result of what investors interpret as the action made by the company. As soon as a company announces a share repurchase, it signals that the management is confident about the future prospects of the business and that they may have the opportunity now to repurchase stock at an undervalued price.
Hello, my name is Luqman Al-Hakim and I'll be presenting about disadvantages of shares buyback. Alright, the first disadvantages of shares buyback is it is a temporary solution for financial problem. The impact on earnings per share can give an artificial lift on the stock. However, it masks the financial problem that would be revealed by a closer look at the company's ratio. Alright, the second disadvantages is unrealistic picture through ratios. Unrealistic picture through ratios means that share buybacks boost some ratios like earning per share, return on asset, return on equity, and etc. However, this increase in ratios is not because of the increase in profitability, but due to a decrease in outstanding shares. It is not an organic growth in profit, hence the buyback will show an optimistic picture which is away from economic reality of the company. Alright, the next one is judgment error in valuation. Through management has better access to information of the company, there are chances that they also make mistakes about valuing the company. If the share buybacks is undertaken with the purpose to support the undervaluation, the company will overestimate the future prospect. This mistake will make the whole process of buyback futile. Alright, that's all from me. On to the next one.
Okay, Assalamualaikum. My name is Wan Muhammad Anas bin Wan Muhammad Rosdi, and I will continue for issue for stock repurchase. There was two issues for stock repurchase. The first one is staff firm of capital. Okay, for the repurchase staff firm of capital, they could invest for the long term, harming workers to the enriched shareholder. It means that the money that they use to repurchase stock will decrease company's capital. If the company's capital drop, it will be burden for the companies to pay salary for the workers. At the end of the day, the people who are holding stock will become richer and richer. Okay, the second issue is companies tend to repurchase stock after period of success. They buy stock in high valuation and they ended up of buying share at cyclical price peak, and they will get fewer share for its money, so it was not worth it. And then they will result in leaving less cash in reserve when the business is getting slow.